Hey guys, Frank Curzio here, and I've been trying to provide updates every day, live updates. So feel free to chime in. I love doing them live. If you make mistakes, you get a chance to make fun of me. But I always like doing them live because I'm going to tell you exactly how I feel. Because this is not so much of an update, but more of a rant, which you could probably hear plenty of my rants on my Wall Street Unplugged podcast. But uh, this morning I'm watching TV and the markets are down, which is surprising, right? Because it's been going up, down, up, down, up, down, up, down almost every day the past 5 days, and now it's two big down days, right? So we're hitting new lows. So I'm listening to economists debate on TV, saying that the Fed needs to raise even more than another 50 basis points. Low interest rates. They need to. Somebody suggested that they give people checks like they did in a credit crisis. They suggested the government right now should pass $1 trillion package, just to stem the risk of this, which I think TARP during the credit crisis was 700 billion, right? This is not the credit crisis. It's not. It's a temporary problem that's going to cause a pullback in growth, right? And a pullback in spending, which is fine, which is a normal course of business. This is coming from a person who's been warning you about this, who's been getting people, my clients, out of the market. And again, I'm not saying that to brag. I talk about my losers more than my winners all the time. But you know, coming from someone that was very worried about this and said that you do have to worry, just to see the measures that they're looking to take because the market is down, and we could see another 10% downturn. Is that a big deal? Well, I don't know. I mean, you're looking at the larger companies are in great shape. This isn't the credit crisis where the financial system is going to collapse. You can't take money out of banks. Commercial paper market was frozen. GE couldn't pay its employees. Well, not even. That's light years from the problem that we're having right now. We're seeing a global slowdown, right? After years and years, especially in the U.S., years of growth. I mean, we're looking at a market that's up 170%, not off the lows. I'm not going to take the lows of March 2009. Let's go for like 2010 when the markets really started bouncing back. We're up 170% even today. We were up 30% last year. And now everyone's like, the government's going to throw money at this problem. We need to solve this problem. You got to be absolutely out of your mind. I mean, the negative consequences that could happen long term. I mean, is this the example we want to set, that every downturn we want to just throw money at it? Because this is a downturn. It's something that's temporary. It could get worse. It can get really worse. Let's see. But there's still a 1% fatality rate. Again, I've been covering this probably more than anybody that you know over the past 2, 3 months. Have people with boots on the ground in China, in Japan, in South Korea that have been emailing me, Italy, all the hot zones. You're looking at a 1% fatality rate outside of China. So if you have a good healthcare system, right? So it's not as bad. Doesn't mean that you want people to contract the disease, but to suggest these crazy measures right now for something that's a temporary problem is just insane. Because when we look at our banks are more stronger than they've ever been. We're looking at the private equity industry with 1.5 trillion in cash on their balance sheets, hoping that markets come down even more. Large oil companies are fine, even though they've come down. They can cut their spending, they can cut their dividends, but they're not going out of business. But you are going to see companies go out of business. And you know which ones? The ones that leverage the crap out of themselves in order to generate more profits. Those are the companies. Hey, if you take risks, then you should pay the price, right? If you didn't see this coming. So if they fail, we have big companies that are going to swoop them up for pennies on a dollar. That's the markets. That's a normal course of the markets. What's not normal is we see a 13, 14% pullback, and we just throw trillions of dollars at it. And the government just prints money like crazy. I mean, is that the way it's going to be? If that's the case, I mean, that's why gold's going higher. I'd even tell you to put a little money in Bitcoin, put a 1% position in Bitcoin. I mean, which is not leveraged to everything that's going on. There's a reason why Bitcoin was created in the first place. It wasn't volatile enough in 2008, and the market cap through 2016 was under 10 billion. That's a $170 billion market cap right now, right? So it is liquid. It provides an alternative, but just to see everybody argue and trying to throw money at this problem to force people to buy stocks when they're more expensive today than they were even before the credit crisis, even before the market came down for the coronavirus risk. So you might be saying, why is that possible? Because the markets are down 13%, they should be cheaper, but earnings are collapsing. Okay, and based on where earnings are expected compared to what we expected 3 weeks ago, where they're supposed to be flat, by the way, they're not going to be flat, they're going to be a lot lower than that. We're probably trading about 19, 20 times earnings, making us more expensive than we were 3, 4 weeks ago when this started. So now you're forcing people to buy stocks at all-time high valuations. I mean, even the cash on the balance sheets that these companies have is pretty strong, over $1 trillion. And yes, they've been taking out debt to actually buy back their stock. So, their balance sheet's kind of like evening out, but it's not a bad move because interest rates are near record lows. So, that debt isn't going to be due for a long time. It's very low interest rates. So I'm not seeing, it's not a credit crisis. It's not a frozen, the markets, the credit markets are not frozen. I mean, no one's really issuing bonds, and they said for a day or two, and I get it, but guys, come on, we got to take it easy here. I mean, it could get a lot worse, and then maybe we take these measures. But right now, for this pullback on something that's a temporary risk, that will end probably in around 3 to 6 months, and it is going to impact businesses. Let it happen. I mean, this is a course of business. You're really going to interrupt this process. You're basically sending a message out to the market that we're never going to let this market crash ever, ever, ever. So just keep buying it. And you know what? I don't like that advice. I don't like buying stocks at all-time highs right here. I like being on the sidelines. Doesn't mean that you're panicking when you take profits when stocks are at 19, 20 times forward earnings. People associating panic with selling. No, it's smart. I mean, Warren Buffett holds forever, but he does sell when things get expensive. It's okay to sell. We're on the sidelines right now. Stay on the sidelines until we have more clarity. When would that be? In about 2.5 months from now, when companies report earnings, they're going to have a much clearer picture. They're going to let us know what they're going to earn for the rest of the year. They're going to let us know it's going to filter into 2021. Then we have something on paper that we can model. Whether we believe them, whether we don't. Right now, most companies are pulling their guidance. We have no idea how bad it's going to be. So, guys, don't buy stocks. I'm sure Monday we're going to see a bounce back because we're at oversold levels. But if you're a trader, it's fine. Right now, guys, stay in the sideline. There's no rush. And it's just amazing because the people on TV who are telling us not to panic seem to be panicking more than mom and pop investors, which is kind of weird when you think about it. I'll report back to you guys soon. Take care.